The market's opening up this morning to a new jobs report that just came in below expectations. Only 73,000 jobs were added last month. You can see all the major indices opening down. That's the weakest month for job growth since the Great Recession ended, excluding the pandemic. The unemployment rate stayed at 4.2%. The picture gets worse when you look back. Job gains for May and June were revised down by a combined 258,000, and you put all that together, and the three-month average is now just 35,000 jobs a month. That's a fraction of where we were earlier this year. Economists say tariff uncertainty, immigration cuts, and high rates are all hitting hiring. And with today's tariff deadline, President Trump has slapped import taxes on dozens of countries with rates as high as 40%. Canada faces a 35% tariff, Mexico set at 25%, and a 90-day extension. China's rate, 34%, set to kick in August 12th. The White House says it's about fairness and national security, but economists warn it could drive up prices and strain relations with trading partners. Joining us now, financial expert Mitch Roschelle, CEO of M2 Communities. Looking at the markets right now, good morning to you, Mitch. Is this a direct reaction to the jobs report? How do you read this?
Oh, it's 100% a direct reaction to the jobs report. And I think in your intro, you mentioned the revisions for the last several months. I think that's the item that the market's most focused on. I would have thought that this would have been a bad news is good news situation. We've seen this with the market before. When you get a bad economic report, the market reacts in a positive way because they think the Fed's going to do something as a result. But since the Fed met yesterday and they're not meeting in August, I don't think we got the bad news is good news effect. I think it's just bad news, and that's what the market is signaling.
And how do the tariff deadlines and word today that they're getting pushed another week play into what we're seeing here?
I think the reality of tariffs is that the uncertainty that the business community or the private sector has been dealing with since April flowing through the jobs report is the thing that, both Main Street and Wall Street are sort of very focused on. So I don't know that the kicking the can down the road and getting another 10 days or what have you has been, viewed as anything other than, this ongoing tariff drama. I think the market and businesses in general just want to have all of this in the rearview mirror. But if you look at it objectively, there's really just a handful of important countries left, our neighbors to the north and south, and our biggest competitor in the planet, China. And those are going to be the hardest ones to get done.
The technology sector, I was talking to somebody this week about coffee being more expensive right now. Which areas are we seeing price increases right now as a result of the tariffs?
I think you're going to see it in materials that we import, parts for, basically much of the supply chain items that we struggled with post-pandemic that are made overseas. And I think when this all settles, the operating model that Trump is using to negotiate, which is a flat tariff, so a country will have either a 10 or a 15% tariff, and then a country's going to make this big investment in the United States over the next couple of years, which is not really well defined so far in the press. I think that's a very, very positive situation, but we're still going to have a situation when there's a tariff. You buy a Japanese car, it's going to become 10% or 15% more expensive. There's just no way to avoid that.
Yeah, that's just the equation. Comes down to math. Mitch, thanks as always. Have a great weekend, sir.
Thank you for watching. Subscribe below and download our NewsNation app right now on your phone, and you will get fact-based, unbiased news for all Americans.